I actually think it's the beginning, because these companies, Apple, Facebook, Google, maybe a little bit Microsoft, are the most sensitive to valuation because they are the most widely held, right? These are the equivalent of US Treasuries in the equity markets, the safest, most predictable safe haven in times of stress. If you want to own big, chunky cash flow generating businesses that, are relatively unassailable, you couldn't pick 4 better businesses than those. And so the fact that they see enough in the horizon to say that we need to batten down the hatches should be a warning to everybody else.
I started working in Silicon Valley in 2001. We were right at the kind of year one of the .com implosion and all the fallout that happened from all the funding that happened from 97 to 99 and 2000. And so from 01 to 03, it was super deflationary. Everyone was cutting costs and all the money that had been raised was kind of being pissed away, or companies were liquidating and, so on. And then starting in 2004, which is actually when I joined Google, but there was also this big movement starting 03, 04 of what people called Web 2. Then kind of new business models and new businesses started to emerge that seemed to have real traction and real legs. And it was a different story and a much more rational story than what you saw leading up to kind of 2000, 2001. And it was around that time when Google started offering these crazy benefits, right? It was there's a gym and free food and all these amazing workplace. And suddenly everyone had to do that to keep up, right? Facebook obviously mimicked it. All the other big companies mimicked it. And then it became mainstay. And they also raised compensation in the Valley significantly because Google had really cracked the nut on how to extract value from the internet. And it really changed everything in Silicon Valley and changed everything in tech, because suddenly every tech company, whether you were enterprise software or hardware or an internet e-commerce site, to be competitive and hire great talent, you have to have the same sort of environment. High wages, great salaries, really share the value with your employees, gyms and free food and all this sort of stuff. So it's the first time, I think, in a generation since 2003, 2004, that we're seeing things start to turn the other way, where instead of adding more benefits, making things more attractive, giving more value to employees, we're really seeing the recession hit these kind of leading indicators of how things are going to be in the Valley. And as a result, I think we should expect to see a similar impact on compensation, on benefits, on value share, and on kind of proclivity to hire, an opportunity to kind of jump jobs, and opportunities that we've all kind of taken for granted over the past 18 years. And this is going to be a real shock to a lot of people that work in tech, and a lot of people that have gotten used to the idea that every company offers great benefits. There's always another job to jump to that'll pay you more. And that as that engine of growth that was really driven by these big companies, by Google, Facebook, Apple, starts to slow, no one needs to compete with them anymore as much. And the compensation bands get tighter, and the option value gets tighter, and the free stuff gets tighter. So it's the end of an era, and I think it's a new world for tech and Silicon Valley.
The big takeaway here is just that nobody is safe. And it's not just startups that have to, tighten their belts. It's these big companies too. And I think we're headed for a broad-based recession. That's what it seems like. You saw Druckenmiller's comments this week predicting a hard landing in 2023. No one's talking about soft landing anymore. In fact, I think we're all wondering who's flying the plane. So I think we're headed for a pretty big recession. And I just take it in a slightly different direction. I'm down here in LA. Had dinner the other night with a friend who's a showrunner in Hollywood. And so a showrunner basically is like the head writer, and they basically put together the writing team and the content for a show, and then they sell them to networks. He said that no one is buying anything anymore here. That last year there was tremendous activity, and you saw the Game of Thrones guys, D&D, they got a $300 million deal from Netflix, and Shonda Rhimes got a $300 million deal.
They did, yeah.
Yeah, they got there were massive multi-$100 million deals being made last year. And that was just for future writing deals. Netflix wasn't even buying libraries when they did those deals.
They were locking down talent for the next decade.
Yeah, exactly. So all of that has stopped. And the reason is that Netflix's stock has been hammered, right? And not only do they not have the capital to do those kinds of crazy deals anymore, but they know that Wall Street is watching them. And so fundamentally, they're questioning whether their business model even works if they have to spend that much money on content. So then all of Netflix's competitors basically have stopped. So this whole like frothy environment that you had in Hollywood last year, that's just over. The faucet's been turned off, and it's not even turned off to a trickle. It's just stopped. So you think that this like massive asset bubble that we had last year was just in crypto and growth stocks. It's not. I think it actually trickled down into the real economy because Netflix was one of those growth stocks. The money then flowed into writers in Hollywood and then lots of other places. This is one small example, right? That this asset bubble wasn't purely just something that's going to be localized to crypto. It affects real people in the real economy. And we are just beginning to see the unwind of that.
My prediction now is that I think the markets are bottoming and consolidating. And this is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of like tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually starting to get a little constructive here. I think that when companies like Facebook really do this, and like if you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply-demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, the next company had gyms and massage and physical therapists, and the other company would have buses to take you to the gyms and massage and therapists, and the next company would have protein shakes that were freshly made. And it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business. And you'll be able to sort through all of that stuff out. So I think it's a really good moment. And again, it's yet another indication to me that I think broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down, the alcohol's being taken away, people are hanging around with a little bit, lights are coming on, they're like, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. I think it is sort of like the end of this phase of big tech where you had this, unfettered growth, where these business models were largely unassailable, and they, were really just fighting to grow into their valuation and just generate more revenue to justify where they traded at. And now it's this next phase where they have to operate more like a cash cow business. And so, it's an acknowledgement that the growth is tapering. It's an acknowledgement that they're going to trade on a pretty tight band in terms of multiple, which means that they have to manage expenses much more tightly, which means that they can't have a really broad-based surface area in which to operate an experiment. You have to keep the experiments small. You have to manage your expenses. You can't have employees basically, run over the place. Management has to have a firm hand in dictating strategy and what people work on.